Hi there, welcome to Kneppy Invest. Are you ready for another financial year 23 result video? Back in September, you gave me a plethora of companies you'd like me to do a financial year 23 result video on. I am slowly getting through them, and right now, as I record this video, I have about 20 more companies to get through, not including this video on Laserbond. So even though we are in a new calendar year, and even though we are very close, in fact, February is just around the corner, and February is quite significant because that is reporting season. The majority of companies on the ASX will release their half year or their full year results in February. In fact, February is my second favorite month of the year, investing month of the year, just after August. I am quite excited to do this video on Laserbond because I'm a shareholder of this company, which naturally means I am bullish about the potential of this company because I'm a shareholder of this company, hopefully for the long term. So if you do find I am being a little bit biased, just keep that in the back of your mind because I do think Laserbond has a lot of potential, and even at current prices, it's not overvalued. In fact, I could even argue it is undervalued. One of the reasons I like this company, apart from the potential, apart from what they're doing, I think is very beneficial for many companies around the world, is the very simple fact that this company's management have given some long-term goals in terms of revenue. And I'll talk about that later in the video. And I really like when companies' management have these longer-term goals. It keeps not only shareholders invested in the company, also keeps management and the employees of the company invested in the fortunes of the company. So I do think it's highly important that companies, every single company, have long-term goals, either revenue goals, profit goals, that sort of thing. Now, I'll talk about what Laserbond does in the next slide. So let's do that right now. But before I do that, this company was founded in 1992 by Gregory Hooper. He had help from his parents, Rex and Lillian. And in 1994, the current CEO of this company, Wayne Hooper, joined the company. So the CEO of Laserbond has been in this company for 30 years. And I'm just assuming here that Wayne Hooper is somehow related to the founder of this company, Gregory Hooper. I don't think it's coincidence that they both have the same last name. Laserbond is a specialist surface engineering company. They provide advanced service engineering products and technologies that reclaim worn parts and improve new parts, enabling significant improvement in wear life and performance. So some of the benefits include higher productivity, lower maintenance costs, energy efficiency, and reduced scrapping of worn parts. They have 3 divisions, or actually 4 divisions. Sometimes I don't really include research and development, but we'll say they have 4 divisions. Services, which is reclamation or repair of worn components for end users, or the manufacture of products that do not incorporate Laserbond's cladding applications. The product division is the manufacture of products incorporating Laserbond cladding applications. These are probably the 2 most important in terms of revenue for Laserbond. The third segment or division is technology, which is the sale of Laserbond cladding technology and associated licensing fees and consumable supply. Now, technology division can be fairly hit and miss, and you're able to see that when we go through the performance of each of these sections. And the last division or segment is research and development, which is just cost related to the ongoing development of new or improved technology, applications, and products. And the reason I don't really consider that a different segment is I believe research and development is beneficial for the other 3 segments. Now, later in the video, as I said before, I'll go through the performance of each of these divisions, but definitely services and the products division are the most important divisions for Laserbond. Now onto the financial year 23 results for Laserbond. Revenue, 38.6 million, which does seem low, but this company is profitable. $4.8 million of profit in financial year 23, up 31.1% from last year, and that was a greater percentage increase than the revenue, which was only up 25.7%. And the reason that's important is because if you can increase your profit at a greater rate than revenue, that means your margins are increasing. And that's one of the things I like to see for any company I own. I want to see margins increasing. So, for instance, gross margins at 53%. And the reason it's very important to see gross margins increase is because if a company can increase the gross margins, not only does it show the company has pricing power, but it also shows there is some branding to the company's name. The other companies that are using this company's services or products are willing to pay a little bit more because what they're doing is beneficial for the customer. Not only is this company profitable, they're also cash flow positive. So operating cash flow positive 7.7 million, free cash flow positive 6.4 million. I'll talk about why there's a difference between profit and cash flow later in the video. And by my calculations, this company has net cash of $9 million. Now, the way the company describes it, they include stuff like lease liabilities as debt. I don't actually do that. So this company would not report themselves as having net cash of $9 million. In fact, they might have or report they actually have net debt. So keep that in mind when you do calculations on anything, that there is a possibility that you might be calculating a different net cash than what I have here. And the reason I mentioned that, it will become important when we look at the valuation metrics, because it does change enterprise value numbers, which is important for me when I do calculate valuation metrics. That'll become clear later in the video. 110 million shares on issue. Now, last time I looked, as I'm recording this video, share price is 89 cents, which means the market cap of this company is only $98 million. And even though I'm a shareholder of this company, I would say right now that I don't think this company is overvalued at all, particularly the potential for growth over the next few years, particularly if the company reaches its 2026 goals. And I'll talk about that more later in the video. $31.1 million of equity, which means return on equity for the company is 15.4, and the return on invested capital is 21.3. The main reason there's a big difference between return on equity and return on invested capital is just the way I calculated net debt or net cash. If you use a company's definition of net debt, net cash, return on invested capital will probably be lower than a return on equity. And the other thing that I haven't mentioned yet, this company is a dividend-paying company. Dividend yield of 1.8%. Now, sometimes I don't like when companies give their shareholders a dividend. And the main reason behind that is, in my opinion, dividends, particularly if a company gives too much of their profits back as dividends to shareholders, dividends suppresses growth and innovation. And I'm only looking for a token dividend. And at this point in time, Laserbond is only giving their shareholders a token dividend. And this is really important because, in my opinion, just my opinion, the main goals and the most important goal of a company's management is capital allocation. And that just means the decisions management makes in regards to what they do with the cash coming in the door. What are they going to do with that cash? Are they going to give that cash back as dividends to the shareholders, make acquisitions, just keep the cash on the balance sheet, that sort of thing, share buybacks, that sort of thing? That's very important. And the main thing I'm looking for are management teams that are looking for ways to capital allocate for long-term growth. That's the main reason I don't like companies that give most of the cash back to the shareholders as dividends, because those companies are not growth companies. The management of those companies are not looking for long-term growth. So dividend yield of 1.8% is fine by me. In my opinion, that's just a token dividend. Now onto why there's a difference between profit and the operating cash flow and free cash flow for Laserbond. And we can find the answers to that question in note 18, which is a reconciliation of profit to the operating cash flow. So they start off with the profit and then work their way down, looking at changes in working capital, which is changes in assets and liabilities. So we're talking about trade receivables, trade payables, and inventories. And those are three main things when it comes to changes in working capital. Has a company significantly increased their inventories? That's going to be important because that could have a negative impact on cash flow, and that could explain why a company's cash flow is significantly lower than their profit. But for the case of Laserbond, their cash flow is actually higher by about $3 million than their profit. So what is the reason? It's not changes in working capital. It's actually depreciation, amortization, and impairment that totaled $3.3 million, which is understandable. This company does spend money on capital expenditure, which means there is going to be a little bit of depreciation and amortization. Now we get to the part of the research process that sometimes I get quite excited, particularly if I see some good value or even deep value in a company. Now, I don't see that with Laserbond when I look at their valuation metrics right now. I tend to focus on P ratio, EV to operating cash flow, EV to free cash flow yield. And when I look at those numbers for Laserbond, I'd probably say maybe fair valued or slightly undervalued, definitely not overvalued at current valuations. So P ratio of 20.4. That's actually really interesting because that P ratio is fairly similar to CBA, but I'd much rather own Laserbond because the potential growth in this company is significantly greater than CBA. When I say significantly greater, I am 99.99999% sure that Laserbond will grow at a greater rate than CBA over the next 10 years. There's probably other reasons why people will rather own CBA, dividend, but even then, the Laserbond dividend will grow from here. I can't say the same thing about CBA. There's a chance that CBA will be a smaller company in 10 years. I think there's a great chance that Laserbond will be valued at 4 times, 5 times, 6 times what it is right now. That's why I would rather own Laserbond and other small cap companies over those bigger companies, just because of that potential for growth. Okay, rant over. PB ratio 3.2. Sometimes I look at price to sales ratio, price to book ratio. I do get a little bit excited when I look at or see the price to book ratio is less than a 1. So a company is trading below a book of value. I get even more excited if I see a company is trading below cash. So you look at the cash on the balance sheet, and then if the cash on the balance sheet is greater than the market cap of the company, that will be time to get excited about a company if it's profitable. If it's profitable. EV to operating cash flow is one of my favorite metrics, just behind free cash flow yield. Also like EV to free cash flow. And this is why it's important how you calculate cash or debt for a company, because that gets into become important when you calculate the EV. So the EV is just markup minus the debt, or plus the debt. It's the markup plus the debt. So if a company has net cash, in fact, the enterprise value is going to be lower than the market cap. So the enterprise value to operating cash flow for this company is 11.6. Now, broadly or generally, when I consider a company to be good value or potentially good value, the EV to operating cash flow is between 6 and 10. And for Laserbond, it's just above 10. So again, I probably would not consider Laserbond to be good value. However, now that's a generalization, and this company is growing, and if they realize their potential for growth over the next 5 years, I probably could argue that EV to operating cash flow of 11.6 is low. Free cash flow yield of 6.5%, I also would consider that to be low for a company that is growing. Also did a reverse DCF based off their free cash flow, and to justify the current valuation, Laserbond needs to increase their free cash flow at 9% per year. And I definitely think the company can do that over the next 5 to 10 years. Now let's talk about Laserbond's financial year 25 goals. This is revenue goals of $60 million. And recently the government gave a little bit of commentary in regards to this target. The board remains confident that it can achieve its stated revenue target of $60 million in financial year 25. If they remain confident, I am confident. Now, one of the reasons I do like a company giving their shareholders or giving the market some goals is I can do some rough calculations based off, in my opinion, this company will increase their margins. If they can achieve $60 million of revenue, increase their margins, there is potential that this company will have profit of greater than $10 million in financial year 25. I think it's a chance. I won't say it's an absolute, but if this company achieves $10 million of profit in financial year 25, having just a market cap of $98 million right now does seem rather low. Now let's just have a look at how the different divisions or segments of this company has performed in the last 5 years, not including research and development. So services, products, and technologies. Starting technology, you can see technologies is just hit and miss. couple of years, nice years in there, 2019, 2022, with above $2 million of revenue, but other years, almost no revenue. So fairly hit and miss when it comes to technologies. I like to see technology revenue actually have some numbers most years. So focus mostly on services and products. And what I want to see is revenue increasing through time in both of these segments. And that's exactly what's been happening over the past 5 years. Service revenue have almost doubled from 11.2 million to 20.6 million. Products revenue has almost doubled over the last 5 years from 9.1 million to 17.8 million. Also included the services and products EBITDA, and both of those have climbed through time. But services EBITDA have improved at a greater rate than products, which means more than likely they are improving margins in services compared to products. So over the next few years, I'm going to be paying particular attention to how the service division is performing, because it seems like it's the best performing division right now for Laserbond. What are the two ways a company's share price or valuation can increase through time? There are two ways. The first way is multiple expansion. So that is the valuation metrics of a company are increasing through time. Or another way to look at it is the market is more willing to pay a premium to own the shares in that company. The second way, and maybe the most important way, for long-term sustainability, increasing valuation and share price of a company is financial expansion. Are the profits of the company increasing through time? So those are the two ways a company's share price can increase through time. For instance, if a company's market cap or P ratio remains at, say, 20, the share price can keep on increasing if the company financially expands. On the flip side, if a company's financials just go sideways through time, share price can still increase through time if the company goes through a multiple expansion stage, if the P/E ratio increases from 12 to 24. Now, there's many different scenarios. You could have multiple expansion while we have financial contraction, or you can have financial expansion as we go through a period of multiple contraction. So this is the history of Laserbond's P/E ratio and markup since the start of 2017. So back in 2017, the P/E ratio of Laserbond was, or as low as about 10 midway through 2017. So when the P/E ratio of this company was about 10, the market really didn't like this company, wasn't willing to pay a premium. And the market cap of this company back then was around about $10 million. So yeah, so this was a really cheap company back in 2017. But over the next few years, what this company did was they became more and more profitable, slowly increase of profit, and the market became aware of this company. So from 2017 through to 2020, in fact, all the way through to 2021, 2022, this company went through a stage of multiple expansion and financial expansion. So we know it went through multiple expansion because the P/E ratio of this company went from a low of 10 to a high of 35 in 2021. Yes, 10 to 35. During that same period of time, the market cap of this company went from about 10 to around about $100 million. Now, what has happened to Laserbond since 2021? Well, this company has continued to expand financially, but during that same period of time, the P ratio of this company has dropped. Multiple contraction. In fact, the P ratio of Laserbond has dropped from 35 at its peak down to 20. That is a definition of multiple contraction. And during that same period, when the company has gone through a period of financial expansion, you can see that the markup of this company has remained going sideways. So it's hovered between about 80 and 100 million, which means multiple contraction plus financial expansion means the share price and the valuation of the company is just going sideways. So there is a scenario moving forward where this company, as it continues to financially expand, undergoes a period of multiple expansion. And that's when the market cap and the share price of this company absolutely explodes. Just like it did between 2017 and 2021. And here is the weekly chart for Laserbond. Back in 2017, in fact, all the way through to 2018, the share price of this company was around 10 cents or just above 10 cents. And then the share price of this company went from 10 cents in the middle of 2018 all the way to a high of 96 cents in the middle of 2019. That is multiple expansion. And really, since that high in 2019, share price has gone sideways. We saw a bit of a dip during the COVID-19 financial panic and the V-shaped recovery, and the share price went back up to its high of $1.04 in the middle of 2021. And since then, the share price has gone sideways. So even though, again, this company has improved financially, they've increased their profit, operating cash flow, free cash flow, share price has gone sideways. So we've gone through a period of multiple contraction. I don't know how low the PE ratio could go from here. Maybe it goes as low as 15. Who knows? But I think eventually, particularly if the company keeps on improving their financial performance, eventually the market is going to reward this company and its shareholders by seeing or increasing the PE ratio, or increasing, the best way, probably the better way to put this, increasing the premium it's willing to pay for this company. As I mentioned earlier in the video, about 20 more companies to do in this particular series. And the next 5 companies I'll be looking at include Sunrise Rice. I think they might just be called Sunrise. A really intriguing ticker, SGLV. I've never had a look at this company before. Then Coventry Group, Maggie Beer, The Reject Shop, and then ResMed. I'm really looking forward to do a video on ResMed. I am now a long-term, or hopefully a long-term shareholder of ResMed, because the share price has dipped back a long way, and I think ResMed is really good value at current levels. That is all I have for this video looking at Laserbond's financial year 23 results. I am a shareholder of this company, so maybe I was a little bit too biased, but I do think there is potential and promise in this company over the next 5 to 10 years. If you're a shareholder of this company, I'd love to hear your opinion, or maybe you absolutely hate this company for some reason or other. I'd love to hear your opinion on why you hate this company. Maybe if you could short this company, you would short it. I'd love to hear your opinion. I'd love to see different sides of the story, because that's how we grow as investors, to take on different opinions. We may not take into account those different opinions, but I think it's very important to look at those different opinions, just like it's very important to look at risks on a company that you actually own in your portfolio, particularly if it's a long-term own. Anyway, so leave any thoughts you have, any suggestions, any questions in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.